Inflation is rising again, house prices have been falling for 4 years, construction is slowing, and billions of dollars is still flowing into real estate. At first glance, none of these make sense. But then when you step back, this is exactly what a transition phase looks like. And the problem right now is simple. Most investors are reading headlines, but not understanding what exactly is driving them. Welcome back to Smart Real Estate by LearnInvestManage.com. I'm Addy Saeed. And today I want to walk you through what's happening in the market right now, not as separate news stories, but as one connected system. Because if you understand how these pieces fit together, you start to see where things are going before it shows up in pricing. Let's start with inflation. The article that I'm referring to is a RBC article labeled "Higher Oil Prices Lift Headline CPI but Aren't Expected to Reignite Systemic Inflation." So the article points out that we're seeing inflation move back up towards 3%, and the immediate reaction is rate might go up again. But here's the problem. The inflation spike is being driven almost entirely by energy. Gas prices have surged. That's what's pushed the number. Meanwhile, core inflation, the one that actually matters, is still sitting around 2.2% and has been easing before this. So let me ask you, are you looking at the real inflation or are you reacting to a temporary shock? Because if policy reacts to this the wrong way, if rates go up in response to energy-driven inflation, we're tightening into a soft economy. And that's where things break. Energy inflation doesn't behave like demand inflation. It doesn't display strength. It signals pressure. Households don't spend more, they redirect spending. And that has real implications for rent affordability, consumer behavior, and business margin. Drop a comment. Do you think Bank of Canada holds or reacts? Because that one decision changes everything. Now, let's connect that to housing, because this is where the second major shift is happening. The article that I'm referring to is, again, an RBC article, which is titled "Focus on Canadian Housing. March Marks 4 Years of Declining Home Prices in Canada." And this is RBC Economic, April 16, 2026. By the way, you can find a link to all of these articles in the description below. So the Canada's housing market has now been declining for 4 straight years. Prices are down roughly 20% from its peak. And this spring, typically the busiest time of the year, is one of the weakest we've seen in nearly 2 decades, actually 17 years. But here's what's happening. This is not a crash. This is a slow grind down. Buyers aren't rushing in. Sellers are adjusting slowly. Inventory is building, especially in Ontario and B.C. So the real question becomes, are buyers waiting for opportunity or are they simply unable to act? Because those are two very different markets. This is no longer a national market. It's fragmented. Ontario and B.C. are under pressure with inventory and price declines, and other regions are showing stability and growth. And that changes everything for investors. You can't generalize anymore. You have to be hyperlocal. Comment below. What are your thoughts? Are you seeing deals in your market or are they stuck? Because liquidity, not price, is the real story right now. Now, here's where it gets interesting, because while prices are adjusting today, the future supply picture is quietly shifting underneath. The next is an article that we had talked about from CMHC, where it's talking about Canada's construction pulse, permits lead and starts confirm. It's an article that was posted on April 17, 2026 on CMHC's website. Again, we'll have the link in the comment section below. So the article talks about how most people talk about housing start, but starts tell you what's already happening. If you want to know what's coming up next, you have to look at permits. And right now, permits are slowing down across major markets. That means fewer projects are moving forward. And because there is a 6 to 15 month lag between permits and construction, today's slowdown becomes tomorrow's shortages. So let me ask you, are you actually heading into a supply glut or setting up for a supply shock? Right now, we're seeing short-term projects completing, supplies elevated, and pressure on pricing. But midterm, fewer new projects, reduced pipeline, and tightening supply. And most people won't see that shift until it's already happening. If you want a breakdown of how this impacts rent and cap rates, comment supply, and I'll dig deeper and I'll set up another episode. Now let's talk about what smart money is doing, because this is where things get very, very clear. This is an article that we posted about KingSett and Choice to acquire First Capital REIT in a $9.4 billion transaction. And this was posted on renx.ca. A $9.4 billion deal just happened in Canada. Institutional capital is acquiring anchor-based retail with high occupancy, stable income, and in urban locations. And this is not speculative investing. This is defensive positioning. So ask yourself, why is big money prioritizing stability right now? Because institutions aren't chasing upside right now. They're managing downward risk or downside risk. And that tells you something critical about where we are in the cycle. We're late enough in the cycle, the capital is becoming very, very selective. So I have a question for you. Would you rather own a growth asset, a stable cash flow? Drop A or B. I'm curious where people are leaning right now. Let's zoom out even further, because infrastructure is quietly reshaping the next phase. So we posted an article from the province of Ontario talking about how they're starting the tunneling process of the Ontario line. So the Ontario line has just started tunneling, and this is massive transit project, hundreds and thousands of people gaining access to transit, thousands of jobs, and entire corridors being reshaped. But here's a key insight. Transit just doesn't move people, it actually moves demand. Every station that is on that line becomes a housing node, it becomes a rent growth corridor, and a long-term demand anchor. And this is how cities evolve, not randomly, but intentionally. And the investors who win, they basically position themselves before the infrastructure is completed. So if you invest in Toronto, which Ontario line stop do you think becomes the hottest? Now let's layer on top of it what corporations are doing. So this is Toyota's announcement in Renex talking about the $300 million investment that they're making in properties all across Canada in 3 major cities, basically. So Toyota just committed $300 million to Canada, not manufacturing, logistics, distribution centers, supply chain positioning. So the question to ask is, why does that matter? It matters because jobs follow logistics and housings follow job. So the main key insight is that this is long-term positioning. Corporations are getting closer to populated areas, they're optimizing their distribution, and they're investing ahead of demand. So the question for you is, are you investing where people are today or where the jobs are going? And finally, let's talk about something happening at the deal level. Let's talk about NDAs and deal control. I recently reviewed an NDA tied to an off-market deal that we're reviewing. And by the way, for anybody that is listening, if you guys have any opportunities for disposition, we're in the market looking for opportunities. We're looking for multifamily and income producing assets right now to buy in southwestern Ontario. If you have any opportunities that you'd like us to take a look at, feel free to reach out. Let's connect. You can reach us at learninvestmanage.com. So we recently reviewed a NDA tied to an off-market deal, and it looked standard until you read it very closely. You had clauses like broad confidential information definition, which meant anything can be classified confidential. There's non-circumvention agreement, which on the surface are fine, but they were so broad that it was worrisome. Restrictions on who you can talk to and financial penalties tied to the deal. We came to the realization that this wasn't just confidentiality, this was control. Some of these agreements are designed to lock you in with the broker and limit your flexibility and control how you act as a buyer. So I guess the question is, are investors giving up leverage before they even see the deal? Let's bring all this together. Right now we have inflation rising but narrowly, housing declining but unevenly, supply slowing but quietly, capital positioning defensively, and infrastructure reshaping demand. This is not chaos, this is transition. So the real question is, are we mispricing risk right now or misreading the entire cycle? If you're an investor, this is not a market to react to headlines. This is a market to understand deeply because the biggest opportunities and the biggest risks are forming before they show up in the data. If this helps you think differently, share this episode, drop your biggest takeaway, and comment what you want me to break down next. The goal of this show is to help investors learn, invest, and manage with clarity and confidence. Addy Saeed is a licensed real estate broker with Remax Gold Realty Inc. and a member in good standing with Canadian Real Estate Association, CREA, Ontario Real Estate Association, OREA, Toronto Real Estate Board, TREB, and the Real Estate Council of Ontario, license number 4735346. Addy Saeed is also a licensed dealing rep with the Westcliff Corporate Finance Division of Westcliff Corporate Finance Services Limited, an exempt market dealer registered and licensed in Ontario. This podcast is for informational and educational purposes only. Nothing discussed should be considered financial, legal, tax, or investment advice. Real estate investments involve risk, and past performance is not indicative of future results. Always consult with qualified professionals before making any investment decisions. Any examples discussed here are for illustrative purposes only. Take care. We'll talk to you in the next episode.